What's up, you guys, and welcome to Money Mondays. A few guys on Instagram have reached out and they've said, how can I get started investing if I have no idea where to begin? What is some basic financial advice to just get started? So before we dive in, I just have to say, this video is for entertainment and education purposes only. This is not financial advice. Invest at your own risk, etc., etc. I'm not a consultant, you're not a client. Always do your own research and do what's best for you. So let's jump into it. So over the years, doing my own research, doing my own experimentation, I've done everything from real estate investing, peer-to-peer lending, mutual funds, index funds, individual stock investments, all kinds of rubbish. And what I found is that if you're not a full-time investor, if you're not a full-time speculator, you want to do something that's easy, that's hands-free, and that takes the least amount of time and effort, or else you will likely, like I did, give up on it. So the first step in investing is to, number one, manage your expenses and manage your income. There's a great saying that what gets measured gets managed. So the best way to have all of your assets and all of your expenses in one place is to join a website like mint.com. This is the one I use, mint.com, and it's a completely free account. It's super safe. I've been using mint.com since probably 2007, 2008, so at least 10 years, and I've never had any security issues. And what's great about this is not only can you see all of your accounts in one place, but you can also monitor your expenses. You can see what your credit rating is. It's updated every month. And you can even set goals within there to, let's say, set a savings goal or set a pay off debt goal. So on mint.com, once you have all of your accounts linked in here and you're using it and keeping it updated, what I'll do is I have an alert in my calendar where every 2 weeks, typically on like the 3rd and the 18th of the month, I'll go into mint.com, I'll open up a couple of spreadsheets, a couple of tools that I use to monitor all my assets, and I'll just make sure everything is on track. I'll recategorize all the transactions, and it takes like 30 minutes. So once you've been using it for a while, you can see what your expenses are. When you're going in here, again, ideally every couple of weeks, and you're seeing if your money is going where you want it to be going. And you get a rough idea of what your expenses are per month. And this will lead us into step number 2, which is start an emergency fund. Now that you know how much it costs you to survive per month, let's say it's $2,500 per month is what you need to survive. It's what your average expenses come out to be. So if you're just getting started and you have no savings, I would recommend starting a 3-month emergency fund. So if your expenses per month are $2,500, you want to save that up times 3. So you have $7,500 in an account. So what I use for a large portion of my emergency fund is Betterment, betterment.com. And I actually have 2 accounts with Betterment. The first one is the Smart Saver account. And this is kind of like a short-term savings account. I believe the interest rate is around 2%, which is great. That's pretty much what inflation is. With a super safe investment account, you're not going to get huge returns. You're not going to get huge gains. But because you're not getting huge gains, there's also not huge risk. Meaning that if something happens next month, you know you're going to have about 3 months of savings in this one account. I have the first 3 months in a Smart Saver, super safe account. And the next 3 months I have in a Build Wealth account through Betterment. And the second account, being a Build Wealth account, it's fairly aggressive. It's really aggressive, actually. The allocation here is it's invested 90% in stocks and 10% in bonds, meaning that it does have some volatility. There is a greater amount of risk, but if I'm in an emergency, if I find myself in an emergency situation, I have the first 3 months of my super safe savings account that I can kind of burn through as I start pulling out the next 3 months and putting that in my savings account. So just within Betterment, I have 6 months of savings. So how Betterment works is it's kind of what you would call robo-investing. So they have AI, they have algorithms, and they're constantly adjusting your portfolio. They're harvesting taxes for you. They're doing all these things. So again, you don't have to think about it. You just put the money there automatically, set it aside, and let them constantly deal with the fluctuations and stuff like this. I'll put a link below this video if you do want to sign up for betterment.com. If you do use that link, you get 3 free months. If you don't, that's cool too. I don't really care. If you do decide to go on your own, you will be paying a 0.25% fee for them to manage your money. So 1/4%. It's not huge, and it gives you the peace of mind to not think about that and just let the robots do the work for you. If you don't have these emergency funds set up yet, I would personally, through my own experiments and trials and tribulations, I would make this a priority to have at least a 3-month savings goal and to bump that up as quickly as possible. Once you start having 6 months, 9 months, and then a full year of emergency savings set aside, you can start taking more risk. There's certain psychological benefits to having an account set aside to where you don't have to start making decisions coming from desperation, and you can start taking inspired decisions. If you want to start taking more risks, starting your own business, going on a crazy trip, stuff like that, you know you have a full year of safety net to kind of find your feet back under you without having to worry about it. Now that you're monitoring everything through Mint.com or Clarity or whatever you choose to use, and you have your 3, 6, or 9 months of emergency savings set aside, you can start looking at investing for longer term scenarios. I know a lot of guys who are still working full time, they may have access to a 401k and they may find a benefit in a Roth IRA. So a 401k typically comes with employer matching, and there's usually a limit set. So let's say that employer matching is $2,000. That means that for every $2,000 I invest in my retirement plan, my company will actually match $2,000. So that's free money. So if you do have an employer and you are fortunate enough to have 401k matching, max that out. After your 401k, start putting money into a Roth IRA. So you fund your Roth IRA with what's called after-tax dollars, meaning it's money you've made from an employer that you're then putting into a retirement account. So if you put this money in a Roth IRA, it can continue growing and compounding tax-free, and you won't be taxed on this money unless you withdraw the proceeds or the money that your money has made before you're at retirement age, which I think they're claiming 59.5 now. So step number 4 may apply to you if you're not employed, if you don't have access to a 401k, if for whatever reason you can't invest in a Roth IRA, then I would start looking at other investment vehicles. One of these vehicles that I use is a target date fund. And how this works is you figure out what year you're going to retire. So let's say you want to retire at the age of 65, and you see what year will that be when you're age 65. You can then scroll through Vanguard.com and pick the target date that is your retirement date. Let's say I want to invest in the year 2050. So what I would do is I would go to, this fund is called VFIFX, and it's the Vanguard Target Retirement 2050 Fund Investor Share. And what's great about this fund is that it actually, because you have a target date of 2050, I mentioned before that I have a pretty aggressive investment through Betterment where it's 90% stocks and 10% bonds. What's good about the Vanguard Target Fund is that as you get closer to retirement age, they know you're going to be needing that money soon. So they'll slowly start to even out that distribution to where you're finally 50% stocks, 50% bonds, and then even start pushing the other way to where it's 10% stocks, 90% bonds. Reason being that stocks are more volatile, even if you're buying the whole market, whereas bonds are fairly safe. A quick note here about investing is that I have tried investing in individual stocks, and for me, it hasn't been worth it. Unless you're a full-time trader and that's your profession, it's not really worth the investment of energy. I know I have some guys disagreeing with me here, but it's kind of like putting all your eggs in one basket. And you can't really control what happens. If I invest in a company and then the CEO gets popped for, I don't know, tax evasion, whatever, Enron, and the whole company dies, that's my entire net worth taking a dive with that company that I have no influence on. And if you think about these robo-investors, these algorithms, not to mention the thousands of people who are on full-time salaries looking to outwit you and outbid you and outtrade you, it's too risky. It's not really worth it, in my opinion. I'm a lazy guy, so I want to have one investment where I can set it and forget it and get a nice average return. You do this through index funds and mutual funds that are low cost through Vanguard.com, and you're buying the total market. So if we jump to the computer, we can see that the Vanguard Target Retirement 2050 Fund Investor Shares, it's up 0.2%. And if you look at the last month, you can see we're actually taking a bit of a dive, going down from May 6th to where we're at now, June 3rd. You can see it going down, but if you look at the max, you can see that it's consistently been going up. Of course, we have the 2008-2009 crash right here, but by 2014, we've already surpassed what the crash was in 2008-2009 and continued to grow even beyond that. So if you're looking at the short-term investment, you're going to see some dips, you're going to see some hikes, but over the long term, over the course of 20, 30, 40 years, then we typically see between a 7 and 10% return. It's boring, you automatically invest, you let your money make money for you, and you're going to get between 7 and 10%. That's going to be between 5 and 8% after inflation. Now that you have at least one retirement account, most retirement accounts have a cap of what you can invest per year. This is because you get a tax credit or a break on taxes That limit is typically around $5,500, which is around $480 or so per month if you're investing the full amount. I know that sounds like a lot, but people spend more than that on a car payment and then have no money in savings. It's crazy. Again, if we jump back to the computer real fast, we can see that if I invested $5 today and I never put another dollar in my investment account and I let it grow, let's say I'm age 25 and I want to retire at age 65, that's 40 years. That's 40 years my money has to keep compounding at an interest rate on the low end of 7%. Again, we should expect between 7 and 10%. If we just invested $5 today, in 40 years, the future value of our money would be $75. That's crazy. Every time you go to Starbucks, every time you buy a $5 Frappuccino, I want you to think about you're robbing your grandmother of $75. You being your own grandmother, of course. Just picture your grandma's wrinkly face, being an old lady, and for every $5 you spend, I want you to feel guilty about taking $75 from your future grandmother self. If you're 25 now and you want to retire at age 65, let's say this year you start your retirement account and you max it out at just the very basic $5,500. And each year you just max out your Roth IRA. Again, you have 40 years at the conservative rate of 7%. By the time you're 65, you'll have $1.2 million sitting in the bank waiting for you to retire. Again, your money will be worth less by then, but it's better to have $1.2 million in 40 years just for this simple investment. I know a lot of you guys are gung-ho and $5,500 per month to get to that $1.2 million isn't enough for you. It's not going to cut it. So you want to invest beyond that. And the next investment vehicle that I use is again through Vanguard, and it's the VFIAX, the Vanguard 500 Index Fund Admiral Shares. It's a mutual fund, and what it does is it invests in the total U.S. equity market, the total U.S. stock market. You're buying the whole market, again, not just one or two companies. So to recap our long-term saving strategies, we have a 401k, if it applies to you, followed by a Roth IRA. Then you have your target date fund, whatever date you want to retire, let's say 2050. And then if you want a relatively safe investment beyond that, I would say the VFIAX, the Vanguard Mutual Fund. Since you're tracking everything in mint.com already, you can see what your income is on average over the past 3 months. Once you've had your account open for, let's say, a year, you can see what your average income is over the past year. And so what I do, as I mentioned, every 2 weeks, I sit down and I just kind of quickly glance at everything in half an hour, make sure everything is still on track, and adjust anything as needed. What I also have is some custom-made tools, and what I'll put in my average income, and I'll have my allocations automatically spit out at the bottom. Let's say you want to start investing 10% of your income. So it'll automatically put in your income here, and then at the bottom it spits out, okay, 10% is equal to this. And what you want to do is set this up through Vanguard. It's called automatic investments. Let's say 10% of your monthly income is $500. Every 2 weeks, I would take out $250, and it would automatically invest itself into these funds that we talked about at Vanguard. There's a psychological benefit to paying yourself first. If you don't see yourself and your future self as worthy of being paid first before all of your expenses and all these crazy bills and everybody else demanding your money, then nobody else will see the value in paying you first either. And there's a certain psychological benefit to having this money taken out of your account, and you have an investment account that's constantly growing no matter what. You're going to see some dips, you're going to see some peaks, in the short term, but in the long term, it's constantly going to be going up. Every 2 weeks, logging in and seeing like, oh, while I was sleeping, my money just made me X amount of dollars increase. And that new money will continue to bring in new money. So the larger your account grows, the faster it's going to grow. So to accelerate this process even further, I set So to accelerate this process even further, I have a reminder set on my phone and in my calendar. And it's something as simple as, hey Siri, set a reminder for every 3 months to increase my savings rate by 10%. And what she'll do is every quarter, every 3 months, you'll get an alert on your phone and it'll say, reminder, increase your savings rate by 10%. And all you have to do is on your spreadsheet, let's say it's 10%, let's say you start at 10%, you bump it up to 11%. And then 12%, and then 13%. And before you know it, you're saving 20% of your income automatically without you thinking about it and without you feeling the pain and needing the willpower to constantly be transferring this money over. Willpower is a myth. What you need is systems and automatic investments that your future self will look back and thank you for. Believe me, I've learned this the hard way. So finally, tip number 5. Number 1, what gets measured gets managed. We're using mint.com, we're tracking our expenses, we're tracking our income. Number 2, have a 3-month emergency fund and slowly increase it to 6 months, 9 months, and finally a year of savings set aside. Number 3, max out any employer benefits. This is your 401k, and then start investing into a Roth IRA. Number 4, open up your own investment accounts. This is going to be your Vanguard Target Date Fund. This is going to be your VFIAX, your Total Market Fund. And if you want to get fancy beyond that, they have a real estate investment trust. They have all kinds of stuff. Just go to Vanguard.com. It's the cheapest one I've found so far, and start looking at what other investment vehicles you have. In another video, we can start talking about after you've invested in all these 4, then you can start looking at speculation. And this is going to be Bitcoin. This is going to be individual stocks. This is going to be speculations, not investments. Finally, tip number 5, which is arguably the absolute most important one. I wouldn't have been able to do 1 through 4 had I not done tip number 5, and that is invest in yourself. And this looks like many different things. One of the most expensive ones, but arguably one of the most beneficial ones, if you're ready for it, is to take trips, network, go to events, meet other people who are years ahead of where you are and where you ultimately want to be. You can start seeing how they interact day to day. You can listen to what they have to say. You know, they say you are who you hang out with. So obviously if your focus is wealth, you want to be around the wealthiest people you can get around. But the problem here is that everyone else knows this rule too, that you are who you hang out with. So why would they want to hang out with someone who's just getting started in business, who's just getting started in investing? You have to invest and buy their time in a sense to kind of get around them. You have to make it worth their while in some way. This could be investing in their course, this could be investing in their program, taking a trip out to see them. There has to be an equal share of value here. Whatever value you can provide, whether that's a skill or a monetary investment, to get the value back of their time and their knowledge and speaking into your life. It is expensive, but it can honestly change your life. I would say a step below meeting the gurus and taking these crazy trips and doing this stuff is to work with a coach. Find a life coach, a business coach, a fitness coach, whatever your focus is for right now. What area of your life are you focused on right now and trying to level up? Again, find someone who's doing better than what you're doing right now in that area of your life and invest in their time. Buy their time so they can help you get to their level. A step below one-on-one coaching is group coaching, and that typically comes in the form of courses. What's a skill you're trying to learn right now, or what area of your life are you trying to level up? Find a high-rated and recommended course and invest in it. You're ultimately investing in yourself. I've taken a bunch of terrible courses, but I've taken a bunch of courses that have changed the course of my life undoubtedly. Not only the course itself, but the people that I meet in these courses, in these group coaching settings. It's crazy to meet someone who's, the same age as you, maybe younger, maybe older, and they're miles ahead of what you're doing. And it's incredible to be in that environment, and then suddenly your head kind of like opens up and you're like, why was I thinking so small? Why didn't I push for that? Why can't I do that now? And it kind of gives you the motivation to see someone else doing it. And because you're in a group setting, you can be like, yo, what's step number 1? How do I do this? And oftentimes, if you're in a kind of peer network, they'll help you get to that level. You can start pushing each other up to get to the next level. Again, depending where you're at and depending where you are when you're watching this video, that may not be an option just yet. Courses are typically a few $1,000s, typically worth it, not always. So beyond courses, I would start looking at books. I would say there's probably 12 to 20 books that have honestly changed the way that I see the world. And a book is an investment of $25, roughly $25, but you can get them for free oftentimes from the library. So on today's topic of fundamentals of investing, I would say one of the first books I read that changed the course of my life was Ramit Sethi's I Will Teach You to Be Rich. And he has a new version, a new updated version out right now. Again, I'll put a link below this video if you want to check it out. But I would, number 1, recommend Ramit Sethi's I Will Teach You to Be Rich. Another classic, quick book is The Richest Man in Babylon. I won't talk too much about it. I actually got the free illustrated version from my local library and read it in probably an hour. It's kind of like a fable that talks about investing and talks about riches and stuff like that. It's worth checking out. It's worth reading, especially if you have kids, because it's kind of like this fable setting. There's nice pictures. And you want to start getting into the mindset and the psychology, I would recommend The Millionaire Next Door, The Millionaire Mind, and then I'm kind of hot and cold about this guy, but Dave Ramsey's Total Money Makeover, especially if you have debt and you're just getting started and you're at 0, or if you're at less than 0, then I would recommend Dave Ramsey's Total Money Makeover. I don't believe in everything he says, but it's a good foundation to kind of get you started. Again, I'll link all these books below this video. If you want to check them out, get the link and click. So that's it, you guys. Let me know if that was helpful. Let me know if I can clarify anything. I know I just had my coffee and it's a million degrees in here, so I kind of jammed through this, but I hope you found some value in at least one or two of these points. Leave a comment below. Let me know what you think. Let me know if you agree or disagree with anything that I said, and let's talk about it. Besides that, you guys can follow me on Instagram @jhausman, where I'm posting each and every day about my journey towards personal development. If you have any questions, just DM me there. And thanks so much. I'll see you guys next week.